Hi, my name is Jim Hilborn,
And I'm Tom Dinas.
and we
are the
Small Business Doctors.
And I've been taking care of business every day. Taking care of business every way. I've been taking care of business. It's all mine. Taking care of business and working overtime.
Profit. That's what we're about. Making
Exactly.
profit.
Net profit.
There we go.
How you doing, Tom?
Good. You too, Jim?
And I'm doing well, thank you.
Okay. We're going to deal with the subject this time. There comes a point in time where it's over. You either can't make a go of the business, you're retiring, can't find a buyer for it or whatever, and you're just going to shut the business down.
Need to get out. There comes
Need to
that
get
time.
out,
That's
yeah.
right. Yeah.
And it happens, to a lot of small businesses, and so you need to know how to deal with it. So we're going to start off with the sole proprietor. Now, we've talked about it before. The small sole proprietor, the easiest form of business to get into, and one of the easiest to get out of too.
Is that right?
Yeah. There's a few things you have to keep in mind, and we're going to talk about it. And the first one is going to be the hot assets of the business.
Hot assets.
Not what you're thinking.
Okay.
Hot
Tom
assets.
from Chicago, folks, and yeah.
Yeah, this is not stuff we've stolen in the past that also got to figure what the heck to do with it. Put it in your trunk and
That's
go
right,
down
yeah,
to the
yeah.
local.
Fell off the truck. Fell off the truck,
Fell off the truck. But anyway, hot assets are certain ones that have tax consequences or financial consequences, right? When you do something to them, acquire them or get rid of them. The cash is a real easy one. As a sole proprietor, just take the cash right out. You're done.
All right.
A lot of people think, well, if I take cash, is it taxable? No, you're not taxed on whether you have cash or not. You're taxed on the profit of the business. So the cash is not really a taxable event when you pull it out. The accounts receivable that you may have left over, now they could be, if you're a cash basis taxpayer, which is the vast majority of small businesses.
That means we pay taxes on the cash we get in our hand,
Right.
not what people owe us.
Yes. Now, some of those receivables are going to go bad, and it's probably why there's some of them hanging around when you close the business
Right.
down. But even after the close of the business, if you receive those accounts receivable, if they get paid off, you actually have a Schedule C, which is where you report your self-employment income from a small business.
Mm-hmm.
It becomes income, and you could get that money 10 years down the road. It's still income when you receive the money. Now, inventory, you've already adjusted for it, and that one could cause a lot of potential tax consequences, both good and bad. It depends what you do with it. If
All
it's
right.
obsolete inventory or it's damaged goods, you can just write it down and take the tax loss when you close the business down.
Okay.
If it's good inventory and you tend to want to sell it off over the period of time, if you sell it for up to your cost,
Right.
you might have a loss. We have a $1,000 pallet of molding or something.
Sure.
And you sell it and it costs you $500 to bring it in. Okay, so you sell it for $1,000, you get a $500 taxable gain. If you sell it for $250, you got a $250 loss. So It's whatever your cost base is in, what you paid for it, and then you compare that to what you sell it for. So sell it for more than that cost, gain. Less, you have a loss. And once again, cash basis, it's when it happens. It's when the sale is done.
In the
Now,
year.
if you're going to just take it to the dump and get rid of it, or donate it to a charitable organization, you can deduct your cost basis in that product.
Okay.
All right. Now, fixtures and equipment also have possibly good and bad things. Just removing it from the business, though, is not a taxable consequence, with the exception of one thing. and it's called Section 179 assets. And this is a very popular way of tax planning where you buy a piece of equipment rather than depreciating it for 4, 5, 10 years, whatever it is, you get to write it off in the year that you buy it. Okay? Which is nice when you're writing it off. You get all this
Oh,
you get all this
wonderful.
deductions
Wonderful.
and save all this taxes and you move on. Those assets, when they're removed from your business, might have what's known as a depreciation recapture. Ugly term. And what it is if you bought something for $1,000, you get 20% vested every year. So
Okay.
that if you remove it in the first year, you have to pay taxes on 80% of the amount that you claimed as a deduction. After 5 years, you're fully vested. It's 20% a year, so after 5 years, it's 100%, and you don't have any tax consequence unless you resell it. Now, all assets like that, like with the inventory, if you sell it, but when you depreciate stuff, your basis is very low. You have to adjust for the depreciation on the transaction. So you buy something for $10,000, it's depreciated down to $5,000, and then you sell it after you close the business down for more than $5,000, you have a gain.
I see.
Less than $5,000, you've got a loss.
And 5, you got to wash.
You got a wash.
Okay.
You got the cash in your run.
Okay, that's called a section. And we know what and fixtures and equipment are basically things that you use in your business to either make a product or make a profit.
And file cabinets and
And you don't
computer
resell it.
equipment. Yeah.
It's not inventory.
Yeah.
But-
But actually taking it out of the business, no consequence. It's only if you resell it later, with the one exception, and that's those ones that you use the expensing provision of the Internal Revenue Code,
Okay.
the Section 179. Then the things, and then there's all, when you're closing out a business, there's all this miscellaneous stuff that you don't think, there was, a rent deposit that you
Right.
put out, and, you get refunds on insurance policies that you paid for. Those things that you've deducted in the past, if you deducted that deposit, when you get it back, it's income.
Okay.
The insurance premium, if you had deducted that insurance premium and you get a refund, that's income.
Which you probably did too. You probably did. Yeah.
Oh yeah.
You should have.
Yeah. When I'm tax planning with clients, sometimes we'll prepay almost a year's worth of insurance and a year's worth of rent if we have a really good year and we want to lower that down. And so we prepay a bunch of bills in December so that we get that deduction that year, and next year
This next
we
year.
worry about next
Yeah,
year.
yeah.
Tax law changes so often and so fast. We only plan for today, because tomorrow,
Yep.
anything can happen, and lately it has.
It has. Yeah.
So things like general supplies and stuff, de minimis value. If you're talking, $50, couple $100 and stuff, just that stuff you just kind of ignore. But if it's substantial, if you have like a machine shop, you might have $1,000 in metal.
Probably do.
Yeah.
You do.
So, and so those things are treated much like inventory. But if you've treated it in supplies, it means you've written it all off. But once again, taking it out of the business, no consequence. Selling it or charitable contribution of it, then you're triggering a tax either benefit or consequence. All right.
Yeah. Yeah. That makes sense.
And now liabilities. Yeah. Get on the right page, Jim.
Okay.
Please.
All right. I'm ready. I'm ready. I'm excited.
Yeah, you look at. Anyway, now liabilities it's a comparable thing. Accounts payable. You're on a cash basis. You pay those bills.
That's what we owe other people.
Yeah,
accounts
that's what we
payable.
owe
All right.
other people.
All right.
If you pay those bills after the business is closed, and I've got one client, they've been paying some back payroll taxes to the state. This business closed down 20 years ago, and we're still deducting these expenses because they were cash basis. And so every year, they got a payment plan with the state, and paying $400 a month. And so we make a deduction on a Schedule C that just has one transaction. Taxes paid, $4,800.
Oh, wow.
Been doing it for 25 years now.
Ouch.
Yeah. And still owe almost as much as
Ouch.
when they started. It is so depressing.
Oh,
It's
yeah.
just like, now loans, on the other hand, is the worst of possible things you can have. Because if you have unpaid loans and you're not going through one of the bankruptcy procedures and you have to pay those loans off, the only thing that's going to be deductible is the interest.
Right.
Everything else is just cash out of your pocket. And that's one of the hardest things to deal with after the closure of a business.
You know, that was the hardest thing for me to understand too when I was, is that why wouldn't we be able to repay off a loan? And it's really because we didn't count it as income when it came in. That's
Yeah, and
you
we
know,
didn't, you know, so yeah, it's very tough. I mean, it makes it,
Yeah.
one of the advantages, and I personally had this, is when one of the businesses that I had go under, is a lot of my debt was deductible. And so it's a lot easier to pay off things with before tax dollars
Sure.
than it is after. Because a lot of times what you're going to do is you're going to go get a job, so they're going to withhold the Social Security, the federal and state, and you're going to get whatever chump change is left after all that.
Exactly.
And then you have to pay off these loans. And so it makes it very difficult. You know, you need to earn $1,000, you know, to make a $700 a month payment.
Right.
So just, yeah,
Yeah.
it hurts.
Painful.
It really is. Payroll taxes, you are on the hook
Oh,
for everything
one of
as
our-
a sole proprietor.
The mantra is always pay the
your
payroll taxes. Yeah.
first.
They're the ones that'll never go away.
Yeah. Well, actually, they will. The federal government is 10 years.
10 years? Yeah.
10 years, the statute of limitations. That's a long time to wait
That
out
was
the
forever
man
for
bill.
me. That
Yeah.
10 years is forever. But
But interestingly, our particular state has no statute of limitations on
was
their
gonna say,
payroll
yeah,
taxes.
yeah.
It goes on forever.
and probably
ever.
that's true for other states as well. But
yeah, ebbs and flows, I would
so
think.
I would just not count on.
Yeah.
If you're in that position, of course, you're going to want to check this out very thoroughly with your local professional.
Mm-hmm.
But do not count. Payroll taxes are bad things to owe. But yeah, so we got to pay those. And what do we got next, Steve?
Well, personal guarantees. This is the one that can come and haunt you when you're not really ready for it, because sometimes this business is going to close down after 10, 20 years of operation.
Right.
And all of a sudden, somebody's knocking on your door and say, well, you personally guaranteed this and this, and so your business is under, that's all right, you're still on the hook for the rest of this lease payment. And you go, no, that's month to month. They go, no, you signed for this lease and it's good until next 3 years, type thing.
Yeah, maybe. That's right.
So you have to watch out for that. And then there's contingent liabilities in every business, stuff
And-
that once that you don't really know how to prepare for because you don't know what they're going to be. And like the man knocking at your door going, well, you were supposed to do this, you didn't fulfill that obligation, and there was a penalty clause in it somewhere along the line.
And we're talking about sole proprietors here right now.
Yeah,
so,
and
so
you're on the hook for it
Yeah.
all. There's no getting out of it.
No layering
So,
of liability. It's you.
yeah,
The
unless-
business is you.
Which is unfortunate. And that's why Jim and I have talked extensively about the use of the LLC. At least it gives you an additional layer of protection.
Corporation, sometimes,
Yeah.
other forms of businesses which are allowed in your state or any state that will shield you from personal liability.
Yeah. Now let's move on to partnerships.
Oh, right. Partnerships.
This is going to be easy because everything I just said
Yeah.
applies to the partnerships.
Oh, well, that was pretty easy. Let's just close the
yeah,
book.
now everybody can go out, get a cup of coffee, and take a break. There is one difference between the partnership and the sole proprietor, is that you have a partner or partners,
Right.
and you are all, what's the legal term? Jointly and severally
Liable.
for
Yes, jointly and
all.
severally liable.
And bill collectors do not care what your agreement is between you in this organization. They will follow the path of least resistance,
They'll go to the pocket.
especially IRS.
Yeah.
They, and they do the same thing in divorce decrees. Well, the divorce decree says I don't have to pay that. And they go, well, settle that up with your ex.
Well, exactly,
They
yeah.
will, and the creditors will do the same with a partnership liability. Who is the easiest one they can collect from? And they'll go after that. And
That's right.
You guys have to settle up on your own.
And they don't care.
No,
And it's just
they
joint.
don't have a heart.
Well, that's right.
Oh, see, we've now covered half of the business entities.
Oh, okay.
Yeah,
Okay.
okay.
And remember that Tom and I we have a segment or two on this that we have done, and we talk about the proper choice of business entities, or how to think about what business entity you want to be and why it might be better for you than a different. We uniformly do not think that you ought to be a sole proprietor.
Or a partnership.
Or a partnership,
Yeah.
really. We think you ought to be some other form of business entity.
And that would be one of them, the LLC, which
Yep.
we're going to cover next.
Yep.
And once again, this is, the IRS does not recognize LLCs. They call them a disregarded entity, because there is no law in the Internal Revenue Code about LLCs.
Well, they're fairly new. They were just
Yeah,
they were just
and
born.
so if you're a single member LLC, you're a sole proprietor. And if you're a multi-member LLC, you're a partnership. So all these things we just talked about apply to the LLCs, with one or two exceptions. And one of them is, and a very important one, if you don't have a personal guarantee, they can't come after you personally for the liabilities, whether it's a sole proprietor or a partnership.
That's right. And one of the things that we were talking about, and we were just saying, well, the IRS doesn't look at it as if it were anything but a sole proprietorship or a partnership. But that's true. And as far as the tax liability goes, that's true. But as far as any third parties go, you do have a level of insulation there.
But now also there's been a recent court case with LLCs. The trust amounts of the payroll are excluded from collection from the members of the LLC. Now that could be subject to change. If the IRS doesn't like a ruling, they'll wait until they get another shot and take it back to court. And this is one
Sure.
of the things you should always check
Exactly.
with the most current rules and regulations in court cases. But right now, and the trust amounts are what you withhold from your employee for federal tax and Social Security. But then there's the matching part of Social Security, and then all the penalties and interest, because you're in this position, you've not paid this stuff, there's, you could wind
Right.
up doubling it. The IRS can go after you personally for just the trust amounts. They can't go after the penalties and interest and employer matching amounts currently. And I
that
think
would
that's
be-
I think that's going to hold, but once again we have to wait and see.
Well, the sympathy, of course, is with the IRS on this, because that was money that your employees had deducted from their paychecks.
Yes. They look at it as though you stole your employees' money,
Yeah,
which
and
is
I-
in bad form.
Bad form, yes, and it's pretty hard to get away with too, but because you got a professional after you there.
Yeah.
But so yeah, and again we've always said, if you pay anything, pay the trust amount of the payroll withholding.
Now we get into the most complex part of it, and that is if
Okay.
you have a corporation or an LLC that you've elected to be taxed like a corporation. So you're filing either an 1120, 1120S, which is an S corporation, or the C corporation, or if you're a professional corporation, a PC. This creates multi-layers of potential problems, because there is nothing like I can take my cash out because it's my cash, and the sole proprietor or the partnership, just take it out. You can't do that because that is another entity, and you can't get it out of the corporation unless you do it in several ways. One is possibly have salaries and bonuses declared,
Exactly.
because most people are self-employed or underpaid.
Underpaid.
Because you're working 60 hours a week and getting paid for 25.
But you get to choose which 60 you work.
That's right. I always like that. I always
Yeah.
go for that Saturday morning and Sunday afternoon because nobody will bother me, right? So even simple things like in the sole proprietor, where you could just pull the cash out, becomes you have to do it correctly. It has to be either salary, it has to be a repayment of loan, or possibly a treasury stock purchase thing, and that gets you definitely want your pros in-house dealing with that issue when you do that. You have to step through it.
Absolutely,
If
yeah.
you're going to liquidate this corporation. The other hot assets we were talking about, the same thing with inventory. The inventory, if it comes out, it's going to, if you just take it out, it could be a dividend, it could be compensation. You have to have a full plan in place as far as how you're going to do all this. The equipment, the same issue. It comes out, if you just pull it out, it comes out at its fair market value.
Fair market value, that's right.
Not its depreciated amount. So you could wind up getting, say you got some, you bought I got one client, a funeral business, and he's maintained two 1963 Cadillac limousines, for years, in this corporation. Well, those things are probably worth 40 grand a piece now. So,
They've gone
but
through being valuable to being worth nothing,
Yeah,
and now they're valuable
yeah,
again.
now
Yes,
they're bad. Yeah, went to. So anyway, you pull that out, and so you've got a dividend amount equal to the fair market value, which is $40,000
Right.
dividend.
Yeah,
So, so when you get in there and you start talking about liquidating the corporation, you have to put the plan in place. You have to analyze all the assets in the business. Some of them will be easy, some of them will be irrelevant, but especially things that are titled, trucks and cars and
Right.
Those sorts of things. Real
Real
estate. Never ever put your real estate in a corporation. That's rule number one. Basic plan, which turned 180 degrees after the '86 tax law, because we used to always put them in the corporation. Now
and I'm going to say that from a legal point of view, there may be some good reasons to do it now, but
In a
from
separate
but from
corporation.
a tax point of view, I'll defer to Tom.
Yeah.
So yeah, separate corporation and lease it to the business, that kind of thing.
Yeah. So, but getting them out, because real estate in the past has appreciated in value, and you've been depreciating it, so all of a sudden you've got a very large capital gain type issue to get out of the corporation. And that's where you hear about the thing called double taxation, because what happens is, since the corporation owns it, they have to sell it. So
That's
they
right.
sell it, they get a buyer, the money comes into the corporation. Now you have to get that money out. So now you either have to take salary, unless there's some loans that the corporation owes you, or you take a dividend. In both cases, you're going to pay taxes twice on the same transaction.
That's right.
Yeah.
And-
There
and-
was a time we could liquidate and spin off, but those things are gone. There's still some urban myth out there that you can still do some of these things. But
Right. No, that's right. And I was going to just explain. A dividend is sort of like, if you own shares of common stock and
AT&T.
yeah,
or,
whatever,
Yeah. Enron.
General Motors. Oh, never mind. Yeah, but if you own some shares of common stock, and once a year you get a check in the mail for a few bucks, and it says, here's your dividend. Now that's taxable to you as a shareholder as ordinary income,
Yeah.
and there's no difference between that and being in a small corporation.
There is also another problem in small businesses, is that in the past, rather than, I can't afford to pay the payroll taxes and I can't do this, so I'll just have the corporation loan me the money.
Right.
Well, if the corporation folds, that loan becomes a release of indebtedness in income to the extent of the amount of the loan.
Ooh, ooh, ooh.
Oh, yeah, you're talking about, a double ouch there.
Ouch.
Yeah, so, there's some ways you might maneuver some of that, but if it's too large of an amount, you've got some serious problems.
Right. Yeah, and very real problems and very little room to wiggle.
Yeah. Now, we're kind of getting down on time, and this has covered the overview of the tax, and especially in the corporation stuff. If you're going to look at closing down a corporation, you really need to talk to somebody that knows what
Absolutely.
they're doing.
Yeah.
Now, there's a lot of times the corporations, if there's no assets in it, we're talking a service company, yeah, you can just kind of file a final tax return and be done with it. But if you got any kind of transactions in there and things like loans and equipment and appreciated assets, you really need to have somebody on board who knows what they're doing.
Absolutely. And
Now, what about the legal thing, Jim? We're going to close this company down. There's, from a legal perspective, there's hoops we got to jump through.
I'm not, Tom, that's a great question, because it sort of dovetails with the tax, but not really. And I know that doesn't sound right, but
Seldom
it
things
doesn't even
attorneys
sound
say
right
to me.
But no, so the LLCs and the corporation, there have some specific rules in most states. The sole proprietorships and the partnerships have basically other rules, because we talked about the sole proprietorships and partnerships as being you. So you're still responsible for any debt the business may have incurred. There's never a change. You know,
Right.
you owed it to begin with, and you still owe it. And if your landlord expects you to pay the rest of a 3-year lease, it doesn't matter to him whether it's Jim Hilborn, ye old antique shop, or Jim Hilborn, you know, working for somebody else. You're going to pay it. If he wants to come after you, he's legally entitled to it. Now, the LLCs and the corporations, as we talked about before, there is generally an ability to shield yourself from liability, personal liability. Sometimes, we also talked about sometimes when you get started and that your creditors have, as a condition of extending you credit, fair enough, made you personally liable. So you've signed twice. You've signed once as the president of the corporation and once as a guarantor of that debt. If you have, you have, and you're personally liable on it. It's probably going to hold up. As far as shutting down the business, it's now, if we're talking about a business with no debt, boy, that's easy. You know, it really is. We just go through our taxes, we reconcile our books, we talk about whether or not we owe or we have deductions out there that we haven't taken yet, or whether we're going to owe the government for income that is now realized that we can't put off anymore. If, however, you owe debts, then that's more complicated.
Right.
And there is generally a statutory scheme in your state for shutting down a small business. Some states call them, you know, a corporation. There can be a corporation, you can be a small limited liability company. Some states don't have those yet, or may not ever have them, but every state has corporations.
Things like notifying the creditors.
Exactly. There's usually a pretty scheme in which you send all of your creditors notice that you are shutting your business down and that your assets do not appear to be sufficient to pay your indebtedness. So I'm assuming that's where we're at.
Okay.
If you got enough money to pay them, then you probably don't need to watch this. 'Cause
And and trail on the corporation after it's closed down, there is one thing. If you start paying expenses of the corporation personally after it's closed down, you can deduct that, but it's like a capital loss. So there's some limitations to that, and you need to discuss that with your financial person.
Exactly, and so, I see we are running out of time. I can't believe you've wasted all the time on that tax crap. But anyway,
Listen
there's
to
a
legal
statutory.
stuff?
Exactly, that's fascinating stuff. But there's a statutory scheme. Usually, you're going to have to notify all of your creditors. You're going to have to give them a certain amount of days to give you a statement of their claim, and you're going to have to then, at that point, those people maybe who didn't do it, they're going to lose. And at that point, you're going to have to distribute the assets that the corporation or LLC has.
And you have to file a form with the IRS
Right.
too.
Gotta let
pending
the state know.
dissolution.
Usually, got to let the state know about it as well, probably.
Yeah.
So,
That's it for now.
all right. Well, I appreciate it. Thank you, Tom.
Yep.